Okay, Peter, I'm asking you to unmute. Welcome back to Face for, I don't know, the 20th time.
Dale, can you hear me?
Got you loud and clear, Peter.
Great.
I don't know how many times you and I have talked. It's almost like,
Right. Yeah, a few times. A few
yeah,
times. Yeah.
and you know what a great time to be. It's always a good time to talk to you. So, if you share your screen, we could move into what you
Yeah.
have on your radar and what you're paying attention to. You know, I also want to acknowledge, Peter, that your last interview on F.A.C.E and then the Trading Summit, I read your stuff, the last interview. You were very constructive. Metals, more so silver, that it had bottomed after that washout in the COVID washout. And I believe that silver even exceeded your expectations, which was a big call when it was trading, you know, $14 of 22, and that was like a long-term target of yours that you know, during this inflation cycle we'd get 22. So with this kind of burst, let's see, you have S&P's up. Okay, we'll get to there. This kind of burst, does it change and make your outlook going forward more bullish than it was, say, 3 months ago?
Well, I mean, it's a good question, actually. I'm reviewing silver right now because you're right to say it. I mean, I'm putting up a chart here, if you can see this.
Okay,
Everybody.
yeah, see, that's the one I saw. You're looking for 22.53.
Yeah, I mean, it was, yeah, of course. I mean, you don't expect it to happen in 4 months, do you, really? I mean,
No. No, I mean, that was, that's right. That was, and you know, time-wise, it was going to take.
yeah, I mean, it was a zero forecast result in time, and of probably
Right.
100%, you know, or thereabouts in terms of price.
Yeah, I think Elon Musk put one of his rocket ships on the bottom of a silver bar.
Yeah, that's right. He must
You
have
know,
done, I think.
had some jet fuel. So
Yeah, yeah.
that anyway, if you wrote it to 22, you did okay.
No,
So
we did really good on this because actually we've got quite a few clients specifically on the institutional side tracking silver with us, and so we do watch it pretty closely. I mean, silver is a bit close to my own heart because I was trading this in the late 70s and, you know, during the bunker hunt time. And
me
so,
too.
you know, when you build up an early affinity like that, well, you remember it too, yeah. And you were trading on the floor then, and I was,
No,
yeah,
I was actually in an office in Beverly Hills
in
working
Beverly
for a
Hills.
commodity broker.
Is Beverly Hills like the Bronx?
Beverly Hills is kind of like you know, Rodeo Drive and things like
Pretty rough
that.
area then, right?
But it's actually a bad memory because, you know, when you have customers, you know,
Mm.
you can try and talk them out of doing something, but it's their account. You have to put the order in. And I actually, back then they had a silver coin contract, Peter.
Hmm.
And the guy got short silver coin bags, and silver was locked limit for, I don't know, 5 days before they changed the rules of
Mm.
liquidation only.
Mm.
And he went deficit. I had to chase him around or eat it. So
Mm.
that's what I remember about the silver squeeze in 1979.
Wow, wow,
Yeah.
that sounds, yeah. I mean, it sounds a bit like the oil fiasco that we had as well in
Yeah,
March,
you
doesn't
know,
it? I mean,
I had to learn a new career from being a trader technician to becoming a collector.
basically took delivery.
Anyway, all
Yeah,
right, let's get out of the time machine and
yeah.
all right,
Okay. I mean, we can come back to silver later if you
yeah,
like.
let's do that because
I mean, it's a
all
good
right,
subject, but
yeah,
I think some of the things which, I mean, you know, we tend to look at a whole right across the asset class. So for those of you guys watching today, if you're not familiar with our work, you know, we specialize in Elliott Wave, and we have, a very sort of cross-section look at all the different asset classes. We're particularly good on correlations, because I think it's very important to sort of cross-correlate. I mean, there are things called Elliott wave idiosyncrasies, and we had a couple of these recently. And I mean, we're not to be burnt by them, but you know, if you do make a cross-correlation, or if you have some particular Elliott wave pattern that doesn't look quite right, you can normally sort of derive exactly what it's supposed to be doing and where it's going to if you just take a look at comparative indices or even sort of different asset classes which have either strong positive or negative correlations. And this gives you a bit more balancing in terms of forecasting, and of course, it's going to help a lot in your trading. One of the most obvious things to me that occurred during the COVID sell-off in March was the fact that, we had a complicit sort of synchronization across the board in particular stock indices and commodities. And they all gave us buy signals right at, within a few days of those lows. And we published them on Twitter at the time.
I remember.
Yeah, I mean, it's just the fact that I know that for those of you watching, listening, if you've seen a lot of Elliott wave work, it differs, and that's where the criticism comes. But really, if you're doing a thorough examination right across the different asset classes, you should come to really the same. Guys in this profession should be coming to the same conclusions, really. My take on this is that we had an intermediate fourth wave correction, which basically began here back in January 2018. And it's an expanding flat. We finished here into the March lows. And we used a lot of FIB price ratios to actually augment and confirm the counts. And, if we just simply take a couple of ratios, I'm using some subliminal ratios to define exactly where these lows should be. And you can see, as I've clicked, they project these levels. And we had them pretty much posted up at the time when we're leading into that low. And you can see the 38% area comes pretty close. I mean, that's certainly within the confines of wave C ending an expanding flat pattern like this. And of course, you know that this is ending a fourth wave in the larger picture. And I think I've got the larger picture somewhere here. Actually, this upside target, Dale, you're probably familiar with, because every time we've talked about it, we've normally talked about 4,400 for the Dow,
Yep.
for the S&P, haven't we?
For years.
For a long time, yeah. And actually, that target we had back in December 2014 in our annual report. Up until that point, we were talking about a number up at around 2140.50. And then when we got to 2014, we could see that emerging markets weren't quite correlating. And this was going to extrapolate into a much broader five-wave pattern. And that's what we've had since, up to 4,400. And that's equivalent to the Dow, where for about 40, between 41, yeah, around averaging 41,000, yeah, something like that.
Yeah, and we talked about at the trading summit some potential time frame. Okay, we'll give you Christopher. We'll give you Peter's. What's your Twitter? It's at Elliott Wave _
Got it.
WT.
Yeah, I knew I'd get a question like that, so I've opened it up already, I think. Let me just find it. Oh, the menu's covering it up. Hold on. Woo.
Yeah.
Let me just see if I can click a tab.
I mean, I have it. Okay, so it's at Elliott Wave _
Okay, thanks.
ELLIOTT Wave _ That's
okay.
Peter's.
Thanks for saving my life.
I can tell how active you are on Twitter.
Sort of. Yeah.
You have to look up your handle.
Yeah,
You're too busy doing analysis.
The guys are doing this and are really helping me with the technology side of things. I have enough to forecast the market. They do their job, I do mine. That's the deal. Anyway, okay, so yeah, this is a fascinating thing. And you're talking about timing. You're right. You were just thinking about timing on the peak, and I looked at this 94-year cycle some time ago. It's this one here.
Okay.
And we publish this twice a year in our annual reports and our mid-year reports, which we sent out videos on our mid-year reports just recently. If anybody's got any interest on those, just text Dale, and then I can tell you later how to get that. But this is a really important one, and it's a very long-term Dow chart, and you can see all we're doing is simply connecting the peaks in this 1835, 1929 era, and projecting it along. And I think, as a generic sine wave, the cycle is okay to do that. This is the correct way to do a cycle, by the way, rather than sort of connecting alternate sort of high lows. A cycle is defined by corresponding peaks or corresponding troughs, and not alternation necessarily, unless it's centrally translated. In this case, the central translations, which happen to be the sort of the midpoints here, the lows, you can see don't coincide with major lows, but they do coincide with thrust to the upside. So you have to figure these things in. And
because I think, when I was a kid, right before the Civil War, that was the deepest recession in depression in U.S. history. I think it was at least 10 years before we got out of it.
This one, yeah. You were just a young boy then, right?
Yeah, I was.
You were in your Pampers.
Spying for the Confederacy back then.
Well, if that's true, you're doing pretty good, actually.
They tore down my statue in
Yeah.
Illinois.
Oh, right. Okay.
Yeah,
You better tell me what your secret
Colonel
is.
Dale Pinkert.
Colonel Dale Pinkert.
Anyway, so that means, gosh, we have, the preppers, Peter, and everyone that's worried about, what's going to happen. Like, we're seeing social unrest here in the U.S. and will there be an election? I think our president just made a statement. Maybe we should delay the elections. That's what someone in the
Really?
is saying, until it's safe, or until the polls change. Okay. So with all of this going on, you would think a lot of people that have been preppers for years are like, we're right here, and you better get ready. But what your work is saying with that sine wave is we have 3 years to get our 2-3 years left to really get our plan together to prepare for when economic conditions and asset prices begin a generational bear market. That's good news, because I tell you what, it feels like it should be now. When you watch,
I agree with you. I mean, if you put the blindfolds on and you just listen to the news stream, and this is the reason why, of course, the fund managers, I don't know whether you get to follow some of the sentiment and tracking of what the big investors are doing, but when we hit the lows in March, all the way up, we were seeing huge short positioning in the S&P futures. If you looked at the commitment of traders, you suddenly see huge short positioning during the recovery during April and May. Yeah. And we went to, right at the end of May, we went to I think pretty much an historic low short position in the net speculative short positions on the COTS, on the commitment of traders reports. And then suddenly, just before this drop in early June, we suddenly had it shrink dramatically. There was a huge amount of short covering as the market sort of started to drop. So as the market dropped...
Yeah, this rally exceeded my expectations. I was thinking 3,100 was going to contain it. I was surprised to see almost 33. So,
well, actually, 3,100 to 3,200. It's a lot when you're trading it short term, but on here, it's a thumb print away, isn't it? I mean, it's not that much. Yeah. And so you'd be forgiven for thinking that. I mean, certainly I was in that camp too, thinking this is generally getting top heavy. But of course, if you just look at the S&P in isolation, you're not really going to, you can be misled a little bit into the timing of when you should be putting in some shorts. I mean, again, take a look at the Russell 2000 or have a look at the, even the Dow sometimes. I mean, we've seen some interesting divergence on the Dow. This rally from, for example, mid-June up, it's a nice zigzag. Ordinarily, I wouldn't have expected it to have even broken back above the June high, but it did marginally. It didn't invalidate the zigzag, and that's why we're on a sell signal right now. But I can tell you that the Dow never broke this high. And those things are really important to watch if you're trading. You may not trade every single index that you're analyzing. Let's put it that way. A big mistake is people saying, "Oh, look, I don't follow that. I'm only trading the S&P, or I'm not following those other indices. Leave me alone." But actually, you're missing a lot of analytical detail if you're willing to eliminate those. Yeah.
How about the last 2-3 weeks? If you weren't watching NASDAQ 100, you would not have noticed the underperformance of NASDAQ. It led all the way up and recently has begun to underperform. So,
Exactly.
you know, that's why you have to look at more than the S&Ps and the Dow. And, you know, I always want to be long the relative strength leader and short what's displaying weakness. And the last couple of weeks, it's been NASDAQ.
That's right, yes. There are other clues as well. I mean, for those of you watching or listening, you're sort of, you know, have a look at Europe. You know, Europe's been very, very interesting. I mean, okay, before we just take a look at that, this NASDAQ, I think, is going to, we should be dropping down, and we should ultimately break this low, this mid-June low. I think we've got this sort of pinned down as a sort of a 1-2-1 sequence, and we should get some downside acceleration there. And we need to balance this whole move because we haven't balanced at all. I mean, if you think about it here, we've got a bit of a correction. You know, these are very similar in terms of size, but we've seen nothing to compensate or to rebalance the entirety of this move, and it's long overdue for a correction. So we need something that's going to break down. And you know, I mean, even if you're using standard technical analysis stuff, you probably do something like this and say, well, look, we're breaking it down, the momentum's lost. So you should be probing to the downside, really. I mean, that doesn't mean to say that you've got to trade short blindfolded without stops, but at the moment, I'm certainly short these indices. When we're talking also about divergences, you know, even if you're not trading Europe and you're located in the US or you're trading US only exclusively, take a look at the Euro Stoxx 50. I mean, you know, this did huge percentage gains from the March lows, mainly because it's very oversold before that. And that's why at the moment, if you look at some of the latest figures from the fund management groups, you'll see that there's huge money being poured into European equities at the moment. Since March.
A lot of that could be dollar weakness.
I think that's the reason for it. I do believe so. I think a lot of the dollar selling is because there's money being pumped into European equities.
Assets.
And it's been mainly because it's been really downbeat. This swing up again, it's emulating what we've just seen on the S&P. It's a nice zigzag rally, and this is starting to head down. And you can see that this report we updated on Wednesday evening, and it's already starting to accelerate down again. And this is why I think it's going to be tugging and pulling down on the indices to some extent. The DAX.
So do we get? So just a little segue here, Peter. Do we get a bid in the dollar during this correction in the S&P?
Well, that's a good question. I sort of I'm a bit careful about the dollar at the moment because the bigger picture is definitely bearish.
Yes.
And when I was looking at the dollar last week, I figured that as soon as the stock market starts to accelerate down, we're going to go bid on the dollar. So I was,
and we didn't.
And we was looking at this, and and this was Friday's update, and I was looking at it and I was thinking, well, actually, if this is declining from March into a 5-wave picture, which would actually fit, you know, in an inverted way to the stock market having a correction down, we should be really we should be demonstrating a lot more upswing from this rejection low. This is a 61.8 correlation ratio of 1 to 3, and just for everybody's interest, if we simply take a 61.8 correlative ratio, by that mean I'm measuring 1 to 3, subtracting from 4. That 61.8 ratio is a very high recurrence ratio for any 5-wave pattern where wave 3 generally is extending. Only in those occasions. But this is you know, this hasn't really. When I see this test, it should really be responding and rejecting to the upside. Yeah. So I'm a bit concerned about that. I'm just wondering, even if the stock market's declining, that we just don't get any traction. And if we don't, then I think the next downside target is here. And that means the fifth wave will be an extension and we'll end up at 91 figure.
Okay.
So I'm watching that very carefully at the moment.
All right.
I haven't made up my mind on that one.
Okay, you know what else hasn't made up its mind, and I know you had a long-term bullish bias on U.S. dollar yen, and it's taken out some support levels recently around the 106 level, and You know, I kind of correlate this to what's happening with the yields, and I do want to get to yields, even though the EKG looks like a comatose patient. Okay, so we're getting close to where you think wave two might end around 405. Interesting.
That's
Okay.
yeah, that's right. I mean, this downswing. I mean, here's the March sell-off, the COVID sell-off,
See, so the
and
Dixie took out that low on the March sell-off, and the yen is putting in a higher, US dollar yen's putting in a higher low above the March low.
I think the
So
dollar
there's more, to
yen.
me, there's more inherent relative strength in the yen than there is in the dollar. And okay, there you go.
Well, yeah, I tend to think that you gotta think that dollar yen is not like any other sort of dollar pairing. It's all about risk on, risk off.
Okay.
And you know, if you take a look at the dollar yen against say the US 10-year Treasury yields,
Yeah,
you'll get positive correlation. So
I believe that.
yeah, I mean, it's very, you know, it's very clear what's happening with those. And also, if you take a look at the
I don't
Nikkei
know. You have to
225
make an
index.
appointment to trade them now.
Ah,
Don't you? I mean, with what Paul did in March, coming in, I don't even know if he, you know, spent $1 on corporate bonds, but the way bonds are trading right now, I've never seen them thinner.
right,
I've never
yeah.
seen tighter ranges, like on the 10-year yield. It's like dot, dot, dot. Like I said, looks like an EKG of you know, someone in a coma. And then there's that old Wall Street expression, never sell a sleeping market. And if there ever was a sleeping market, it's yields the last 3-4 months of going sideways. The universal thought is lower for longer. And I look at your forecast for the yen,
Yeah,
and if that plays out, the big surprise is going to be higher
to the
yields.
upside.
I think that would
Yeah.
be the most unexpected event in the market, would be higher yields,
I
Peter.
think
Do
you're
you agree
right
with me?
because, yeah, absolutely. Because actually, I mean, that ties in with gold, doesn't it? Because if you read all the gold analyst reports recently, and we've had tons and tons and tons of my email box is full of gold at the moment, reports.
Right.
And
Yeah.
all the analysts are saying, yeah, extrapolating up and going crazy. I mean, yesterday it was, you know, there was analysts
Yeah.
saying, well, if we use a 7 times multiple of the low in 2016, that means that we're going to see $8,000 for gold. I mean, come on. I
Yeah.
mean, please. I mean, I'm bullish for gold, but please. I mean, let's get realistic. This 10-year yield I'm showing really because of the pattern correlation with dollar yen. You can see that here's the low for dollar
Yeah.
yen in March. Here's
Right.
the rally, and you can see the same, you know, zigzag downswing. If I just toggle back, you can see here pulling
Yeah.
down. Can you see the same
Yeah.
type of zigzag pattern down here? And
Yeah.
I think you're right. I think the pain trade for the bond traders will be a massive sell-off in the bonds, yields trending up. We're not quite ready to do that yet. We've got to get down to, you know, I'd like to see this correction finish from March. And
We're
that's
10
where, you know,
bips away.
yeah, it's not much now. I mean,
No.
it was a lot, you know, sort of back in June when we were at 95. It was a brave call that we made down at the time. But yeah, that's looking as if it's a done deal. The thing is that when yields tend to trend up, you tend to see the
There'll be opportunity costs for gold again.
well, the big question with the analytical reports, the analyst reports in gold, is that everybody's sort of said reason why gold's going up is one thing only: low interest rates
Right.
in perpetuity, pretty much. I
Right.
mean, the Fed, even their guidance, you know, have said, look, we're not doing anything until we come back from holiday in 2021.
Right.
So, you know, you can understand why the markets are feeling comfortable with that issue. But all I can say is that the Fed don't control the long end, or are they? I mean, there's been talk that they might try and dip in like the Japanese have done to try and control the yield curve. But if market forces prevail, I think they're going to find it tough to do that.
Good.
If we get through the next correction down on the equity markets, I've got a 12% drop on the S&P that I showed earlier.
That's when we should get this next drop in yields to your 44 level.
Yes, I mean, the timing here, I don't know whether this will occur at the same time that the stock market bottoms. That might sort of flatline for a bit if it gets down
Yeah.
here. I wouldn't expect ordinarily a break below the March low. That's not in my vocabulary at the moment. But even so, this would suggest that the yields would start to trend up later this year in a very significant way. And what is that going to do to gold? Well, it's going to, if everybody's pinning their hopes on gold continuing up at this pace on the basis that we're going to see a prolongation of lower yields, I think you have to rethink that idea. That's going to be significant. And coming to gold, I'm not sure how much time we've got, but
no, go ahead. Why don't we wrap it with gold?
Yeah, okay. I'm just going to show a gold forecast which I posted on Twitter the other day, because when I saw a 3,500 forecast for gold at this juncture, I thought it might be a good idea to remind what we've done in the past. This is what I posted. This is the chart I posted on Twitter, and it was a gold forecast I did back in June 2018. So we're talking about, just over 2 years ago. And at the time, gold was trading at 1256. It was coming down. We were forecasting this as a horizontal flat pattern for those that you familiar with Elliott wave. And we said, we'll get down roughly to this area here, and then we're going to start this big uptrend for primary wave 3. And the targets were 2035. Well, it's interesting because there's a bit of reverse engineering going on to get that number. But of course, 2035 isn't that far off from where we've been even yesterday or overnight.
Yeah, right.
We've been up to 1980, which is, a few fingernails away from this 2035 area. If I show you the real-time chart on gold, you'll see how the reverse engineering works with this, because basically what we've done is we've assumed that wave 4 will be a 38% correction, and the fifth wave, this target at 24.72 is derived from our very long-term targets, which we did through fib price ratios going back to the Great Depression lows when gold was at sort of sub $35 an ounce. So we wanted to maintain that as an upside target. And then what we did was we assumed that the fifth wave would be again a 61.8 correlative ratio of 1 to 3. So we've gone like this. And if you reverse engineer, that means that the target is 2035, 2040. So if gold hasn't already hit a top, which it might have done, I'm short a little bit, and I'm prepared to sell some more on a scale-up basis, then this market is primed, ready to come down pretty soon.
You did it again, my trading warrior brother. Great content. And for people that want to continue to follow your work, you want to show them your site.
Thanks, Dale. Appreciate that. Anybody who would like to, by all means, come and follow us at Twitter. And Dale gave you the address before, so I think that's here. And we'd be more than welcome to welcome you to our Twitter accounts. And then if you'd like to subscribe, this is the front page of our homepage, wavetrack.com. And if you go on subscriptions and go there, first page is our Elliott Wave Compass report, and this is our entry level for a very thorough, concise report which we publish twice a week. You can log into this online and view the charts online, or you can just download the PDF document once you've logged in. And we're covering all the major stock indices in US, Europe, and some Asian stocks. And on the currency side, we're doing euro dollar, we're doing dollar index, British pound, dollar yen, Aussie dollar, and even Bitcoin for those that are interested in that. And you can subscribe. It's $39 a month, so you get two reports per week. And you can always email us if you've got any questions, because we're always happy to answer them, because there's a lot of detail in those reports.
Peter, thank you so much for coming in and giving us some great market concepts to keep in our market memories. Look left on your charts for the market's memory. My memory, it's still okay. I mean, I did remember 22 silver, so
absolutely.
I can remember trades, and I can't remember how to find my way home. I get lost in my own neighborhood. So anyway, Peter, I really appreciate your work. I respect you, And thank you for coming to edify the F.A.C.E community today. Hope the pips just keep raining down upon you, brother.
Thanks very much, Dale, and a pleasure to be with you and everybody today. Thanks a lot, everyone.
All right, everyone. Peter Goodburn, that's a wrap. And we'll wrap up the week tomorrow. Remember, don't just count your pips or your Krugerrands or your bushels of wheat. Wheat looking pretty good. Count your blessings, and we'll see you all tomorrow. Adios. Thanks again, Peter Goodburn. You're welcome, Cedric, Monica, Brock, Barry. See you guys tomorrow. Don't forget, if you want to join, send Joe an email. He'll give you a deal. You're welcome, Yosh.